Welcome, everyone, and thank you for joining. I'm Diamond Nabi, principal at SEG. I'm excited for today's discussion because the topic is critical to every SaaS operator. We will be covering how to structure and manage your financials in a way that not only fuels your growth, but also sets you up for long-term success in the eyes of potential buyers. We will be answering questions throughout the discussion, so if you have any questions now or while we present, just click the Q&A button at the bottom of your Zoom window and submit your question. Today, we'll break down what a great SaaS P&L looks like and how it helps leaders make smarter decisions, invest in the right areas, and avoid pitfalls that slow growth. A well-built P&L isn't just a record of performance, it's a tool for scaling effectively and building a predictable business. And then when it does come time for M&A, those same practices matter. Buyers are more selective and they're digging deeper than ever. So clean, accurate financials not only reduce friction and diligence, but also signal a well-run company capable of sustaining growth. And that is what drives stronger valuations and smoother processes. I'm joined today by Ben Murray, also known as the SaaS CFO. Ben has worked with hundreds of SaaS businesses on their finance function and brings unmatched expertise on the metrics that matter, the mistakes that erode trust, and the practices that allow companies to scale while also being exit ready. Ben, can you please introduce yourself and then we'll dive in.
Thanks, Diamond. Great to be here. So, Ben Murray. So, I got my finance start in the airline industry in FP&A, and then got into software in the early 2000s, back in the on-premise days. Worked my way up through FP&A to SaaS CFO at founder and private equity-backed businesses, and for the last 4 or 5 years, have been helping SaaS founders with their finances, coaching, have an academy teach SaaS metrics and finance, and just generally dive into SaaS and B2B finance. So great to be here.
Great, thank you, Ben. All righty. So when I started in SaaS M&A about 11 years ago, growth alone got you a lot of credit, but it's not the case anymore because today buyers are digging deeper. They want to know that you're not just growing, but you're growing efficiently, the growth is durable, and your margins are strong. So even if you're not in a position to sell right now, clean financials are what lets you scale with confidence today. So you can make better decisions, invest in visibility, and then when the time does come where you want to do M&A, buyers will pay up because they can trust what they see. So in the next few slides, I'll go through some basic foundational information on why this all matters in the context of M&A, and then we'll get into the meat of how to structure your P&L for success with Ben. So why does this all matter now? It's because the market has changed. And the biggest change that I've seen over the last decade is that the PE community is dominating the M&A market. Nearly 60% of all deals involve some sort of private equity, and these are the most disciplined buyers in the market, and they dig really deep. And if the numbers don't tie, they will discount that and or walk away. So I was working with a client once to give you some perspective on this, and their financials were pretty messy, and we did our best to clean it up, and they did their best to clean it up. But across systems, everything was just a little bit off. A couple numbers didn't tie, and eventually we got to the point with a private equity buyer that said, you know, this is just death by 1,000 paper cuts. I can't really trust what I'm seeing because nothing's really tying out. And it's not egregious, but these little mistakes here and there are concerning, and I can't trust what I'm looking at. So the market is changing because buyers are digging really deeper, especially the private equity community. And then on top of that, activity is very strong and valuations are holding steady. But here's what's really interesting about this is that the spread between the top performers and everyone else is widening. So what that tells us is that the market is very selective right now, and it's rewarding the best prepared companies. And the companies that are winning are the ones that have clean and compelling metrics. And buyers today are spending more time in diligence than ever, and financials, as we could all imagine, is getting the most attention from buyers. And at SEG, we're always telling our clients that we want to speed through diligence, and diligence should always be confirmatory and not exploratory. And the only way that happens is if your house is in order. So to give you an example of this, we just recently closed a deal where diligence moved faster than closing on a house, which is crazy, but it was partially because the financials were clean and everything lined up. So when a buyer got to the diligence phase, it was checking the box, everything tied out, we didn't have to dig deeper, and we moved through the diligence timeline extremely quickly. So if the house isn't in order, suddenly you're in weeks of repeated Q&A, you're trying to reconcile your numbers, and that creates frustration. And it's eventually going to create doubt in a buyer's mind, to go back to the story that I told earlier, and then ultimately deal fatigue. And as we all know, time kills all deals. So that's really not a place that you want to be in. Clean numbers are going to show that you're disciplined and you're credible, and that perception with buyers matters almost as much as the numbers themselves. And messy financials don't just make it hard for you to run your business. As I mentioned before, they're destroying trust with buyers from the beginning of the process all the way to the end. And I've seen this play out as well, where a company looked like it was firing on all cylinders, growth was strong, sales momentum was there. But when we dug in, the unit economics was telling a very different story. So inside the business, it was actually creating this kind of false sense of security with leadership, where they thought they were scaling well, they were scaling efficiently, but in reality, every new customer that they were bringing on was adding very little to their gross margins and very little to their bottom line. And I knew that if a buyer got that, they would immediately pick up on that and start questioning whether the business could really sustain its growth. And instead of rewarding the company for all the top line expansion, the buyers would discount the story. But I've also seen this on the flip side, where the numbers are really clean and the story is consistent. So buyers aren't actually getting bogged down in the defense and trying to dig into numbers. They're spending more of their time building conviction around the growth story. And that's a big part of where we spend our time at SEG. Because when I'm in a process, I'm trying to make a buyer's job easy so they can go to their boards or their IC with confidence and fight to win a deal at a higher valuation. And this always starts with the financials and how well run the business is. And visibility and this cleanliness really creates leverage both internally and in M&A. And this slide shows the domino effect of that. It seems really intuitive and simple, but it's incredibly important. So clean financials will lower perceived risk. Lower risk will drive excitement. That excitement means more buyers are sticking around in later rounds. And that cohort is going to drive competition, and then that competition is going to push valuations higher. But even beyond M&A, think about what that means internally. So if you as a CEO or a CFO have the confidence in your numbers, you can invest in growth with conviction. You could tell a better story to your board or your investors, and you'll avoid costly missteps. So this visibility doesn't just create better exits, but it creates better decisions along the way. And that brings us here. I always say that the best companies run like they're always for sale, even when they're not. And the companies that I've seen get the best outcomes don't wait until they're ready to sell to clean things up. They're running disciplined businesses day in and day out. And that discipline sets them up to grow faster and react quicker. And when the timing is right, maximize valuation. And with that foundation and the lay of the land, I will pass it to Ben to dive into actually how to structure your financials the right way and how to get yourself in a position to grow your business and get exit ready. And like I mentioned at the start of this, if you have any questions for me or Ben, just submit them and I will moderate them throughout the discussion.
Thanks, Diamond. So many great points there. I could talk for hours just on what you covered there. And again, yeah, if there's any Q&A, throw that in the Q&A box. Would love to take Q&A at the end. But for key SaaS finance data sources that we have to be prepared for internally and for external parties. And Diamond, actually just this week, this founding team that I'm helping, they have some acquire interest. It's a strategic backed by a very, very large, well-known investment firm that everyone would know. And so they sent me the email while we are on the call, and they're like, "Hey, they're looking for some of these numbers, and they want to have another conversation." And and looking at the numbers, CAR, ARR, retention, net new ARR, gross profit, OpEx profile, and it's like, "Yep, we've got all of that." And why do we have all that? Because we have these four key SaaS finance data sources in place, and that's why the previous slide you talked about, all right, you hear a lot just like run your business to run your business, not for exit, but really it's, when we put these data sources in place, there are two purposes. One, so we have the data, the metrics we can internally, so we can operate the business. And then if we talk to third parties, if we get those knocks on the door, we're ready. It's not going to take weeks to spin up those numbers. If they knocked on the door this afternoon for my one client, they're ready today to have a meaningful conversation. And this is the foundation that I'm always helping founders with and in my course. And let's start at the top here. So financial, right? So the SaaS P&L is so important. Your chart of accounts, coding expenses to the department level, clear and distinct revenue categories. There's so much that goes on in that financial piece. So that's number one. Second is bookings. So that closed won data, so important. Without closed won data, we can't calculate any go-to-market efficiency metrics. So that's so important. And if you're like, hey, Ben, I'm self-serve, I'm PLG or AI outcome-based, I don't speak the bookings language, it still applies. We're still going to take your MRR waterfall, your MRR schedule, create an MRR waterfall, and then derive your bookings data. We still need to know where your growth is coming from. Is it new expansion? What kind of contraction do you have? What kind of churn? So it still applies to every SaaS and even AI business. And then the box of the circle at the bottom, people. So we need to know how many FTEs do we have? How many contractors? Do we have agentic AI on our org chart now that are replacing people? So we have to understand org efficiency. And I have a metric called the ROSE metric. It's more refined than revenue per FTE. And if you're looking for that path to profitability or durable growth, which is that hot term now, we have to understand org efficiency. And then finally, customer slash revenue data. So this is our MRR schedules, our MRR waterfalls, revenue by product line, retention by product line. Of course, those numbers that any acquirer are going to want to know, and we have to know internally. We have to know gross revenue retention, net revenue retention, customer retention. So it takes time, but this pays off so much later on, when we are talking to third parties, when we're presenting to the board. So this is where it always starts in SaaS, is this data foundation.
Right. It goes back to just always being exit ready. So when that inbound does come in, you're not scrambling to get things cleaned up. But on this slide, I think a question that often comes up with my clients is what kind of metadata should they be tracking? Like, is there a standard list that you tell your clients this is absolutely what you have to be tracking in terms of your customers?
Yes, it comes up a lot because once you start scaling and depending on your price point, if you're getting hundreds of customers or thousands of users, then it's time to think about segmentation. And especially it's relevant with your customer data, your revenue data. Should we segment by product line? Should we segment by a firmographic? How do you slice and dice your customer base? Because also buyers are going to want to see that. Like if you present, hey, we're running 90% GRR. All right, well, and you've got 1,000 customers. Well, I need to know a little bit more than that. Maybe how's product line A performing? Maybe we have a legacy product line that has lower retention. So it's
Yeah.
that metadata, and that's really important. What I see is, we may be using Stripe, QuickBooks, Salesforce, and they all have different customer names. It could be the SaaS CFO LLC, the SaaS CFO Inc. And then we have a hard time tying this data together. So that's where CFOs have to come into play here is, all right, that data architecture between your CRM data, your financial data, customer data, that syncs together. Especially we could be invoicing out of Stripe, QB, all these places, it adds more complexity. So definitely on the customer side, the customer name side, so we can pull these data sets together.
Yeah, and I think just anecdotally with my clients, a lot of them fail to realize how important segmentation actually is. And realizing that you could tell a far different story about your business that you might not even know is happening behind the scenes when you're actually able to segment across different data sources and looking at different verticals and geo and all of that good stuff. So I'm really glad that you brought that up. We did get a question from the audience here. What is an MRR waterfall?
Ooh, great question. So these are called different things, Emmer waterfall, roll forward, snowball. But Emmer waterfall, so it always starts first with what I call an MR schedule. So that's revenue by customer by month. That allows us to calculate retention. So we take our MR schedule, and from that, we then create the MR waterfall, which is the beginning balance of MRR plus any new that came in, expansion, contraction, churn, and that results in our ending balance, and that starts over again next month. Now, if you charge by credit card, maybe you have a reactivation layer in there, something like that, but that's our waterfall. So new expansion, contraction, churn, ending balance, it starts over again. And with the MR waterfall, then I've got a retention template. It just calculates all the retention for you. So that's so important. It seems so easy, these MRO schedules, Diamond, but that's often the biggest holdback is like a clean MRR schedule.
And it gets complicated when you have different billings, different
Yep.
contract lanes. It's extremely, I would argue to say an MRR waterfall is the most important thing that you should be tracking.
We'll see a slide. Yeah, exactly. It's so important. We will see a slide in a bit.
Okay, and then last question here is, what is the best way to tie a singular customer across multiple data sources?
Oh yeah. So that's where, say, as a CFO, say I oversee the accounting software and stuff on my side, but that's where I've got to work with my Salesforce admin or whoever it is and my AT department, whoever is architecting these systems. And we've got to then work on, all right, do we have a unique ID that goes across all systems? Or maybe when it's created in HubSpot, that ID becomes the system of record ID throughout. So I'd say no magic pill here, but I think it's just actually a dedicated effort that the CFO, admin, other leaders at the table, we come together and decide, where does that come from? What's the genesis of that customer name and that ID?
Yeah, I think the idea is one that I love to see when I'm working with clients because, as you mentioned earlier, something as simple as an extra space, you can't track it across your ERP and your CRM. So I like that. Okay, great.
Yeah. And yeah, you've seen probably in the request, like, all right, I want to see total revenue by customer. That could be subscription usage services revenue, and then pulling all that together can be a lot harder. So yeah, it definitely pays off.
All right.
All right, so the modern SaaS and AI P&L, I talk about this a ton. The SaaS P&L is so important. Such an important financial tool as operators. And also, when we go and talk to a third party, just this example just yesterday of understanding gross profit, understanding the OpEx profile, it's here with the SaaS P&L. If you're exporting that native QBO P&L, and it doesn't matter, QBO 0, whatever software system you're using, if just using that native structure, it's going to be just so difficult to have meaningful conversations. So even with this, you're going to get ahead of probably 80, 90% of your peers by putting this in place. And I like to say, it makes your financials easily consumable for your board, investors, and potential investors. They know your business model. One of the requests this week, all right, I want to understand COGS. If you just have one line on your P&L that says COGS, well, what's in there? Are there people? Is that just hosting? So let's start at the top here. So important, clear and distinct revenue streams. We have to have distinct revenue streams. So subscription separate from variable. And now I call it variable because that could be usage, processing, transaction, etc. So that variable based revenue, don't code that in the subscription. We've got to have that separate. And then professional services. So setup, configuration, training of our customers, that one-time revenue. And then I see this a lot, Diamond. I don't know if you see it, managed services seems to be coming up more and more, where it's people-powered revenue. And that's a big deal. On your P&L, figure out what's people-powered revenue where you may not get as much credit for versus IP-powered revenue. And with managed services, it's services on a subscription basis. So maybe we're going to run custom reports every month for that client, and it's on a recurring basis. We're going to break that out from the one-time services revenue. Then I've got some customers with a hardware play. They also sell hardware with their subscription. So important to have these broken out because then that third party can easily understand what's happening on your P&L, your pricing models, et cetera. And again, Diamond, I had one company I was coaching, they had to go back, restate all this because in due diligence, they were coding subscription and usage revenue to one bucket.
Yeah. Yeah,
So
I
they,
think, yeah, one of the biggest exercises that we go through is gross margin and COGS and trying to figure out how much you're getting from each revenue stream. So not just your IP, but like you have different product lines, like you said, managed services, services. We want to know the margin on everything because again, we want to tell the best story. And if you have some sort of blended average of all the different line items, it could tell a far worse story than you want to tell. So you're really missing out on an opportunity to tell a good story to buyers and M&A by not doing this.
Mhm.
So a question for you on COGS is
Mhm.
outside of, segmenting COGS based on product lines and all of that good stuff, basic, what should actually be included in COGS? And what would you consider a good gross margin for a SaaS business?
All right, yeah. So that's the next step here. So COGS, cost of goods sold. I know it's an old school term, but it's what it takes to deliver on our contractual obligations here. So kind of, I hate to say back in the day, pure play SaaS, tech support, customer success if they don't sell. There's always that big debate, customer success, where should they be? Services, if you have set up training configuration, and then DevOps, hosting, security, compliance, production facing, customer facing hosting. We can also slice and dice that bill if we need to, but that's definitely should be in COGS. And then if we have managed services or if we have variable revenue, sometimes we have hard expenses with variable revenue. Say we're charging for every text message that goes out and we use Twilio in the back end, and I've got this transactional line here in COGS, then those hard Twilio expenses are going to go there. Now, sometimes it's pure profit. If we're just taking a cut of the processing fee, all right, perfect, 100% gross profit. But others, there are hard expenses associated with variable revenue. Maybe those tokens, LLM models, etc. So we need to call those out in COGS. And then we're set up correctly, one, to accurately calculate overall gross profit margin. And then two, so important, margins by revenue stream. So we can see what's contributing to our overall gross profit. Like here, we're running 80%, which is considered best in class for pure play SaaS companies. Now there's a big debate on AI. I don't know if we want to get into that, but but what if we're running 55%, 60%, and we're a 10 million company and we should be better than that? Then we can see, all right, what's contributing to that weighted gross profit, and then we can dig in and focus on what's working, what's not working.
Yeah, that's great. And one question from the audience is what's in variable?
So variable. So again, in the revenue area, this could be usage-based revenue, processing, transaction, consumption-based revenue. It could be outcome-based revenue. Now, it depends on how material those are. Sometimes for clients, we'll break that out if they have usage and also processing revenue, and those are material. We'll probably call those out in the P&L, but so I'm just using variable as that bucket for usage. Generally, that rate times volume revenue.
Got it. All right, we're getting a lot of audience questions on this slide. I'll ask these two and then we'll hold the rest till the end
Okay.
of time. Okay, so if customer support is responsible for renewals, what is your opinion on where it's classified, COGS or sales and marketing?
Ooh, so renewals, yeah. So if they are working, say it's a 3-year contract, 1-year contract, whatever it is, and we're 2 months out, 3 months out, and need to renew that customer, put the new contract in front of them, I do consider that more of a sales function, and then would put that down in sales and OpEx because it is commercial related, customer related, and they are trying to get that renewal again. So yeah, I would not put that up in COGS. I'd have that down in sales.
Yeah, agreed. And then this next question, I like this question a lot because I see this in a lot of businesses that we work with. So we are a split subscription payments business. We have compliance costs that are associated with KYC onboarding. It is variable by the number of people we pay, but it's also a one-time event. Is it COGS or is it not?
Ooh, yeah. So I'm interested in your opinion, but I think anything ongoing that's again required for our revenue stream. So if you need this compliance in order to serve your SaaS product, then that's going to be, I'd code that in DevOps because it's needed. right? That's contractual obligation we have to perform on the compliance side. Now, one-time expenses, it just depends. If that's one time and then we don't pay that for, 4 years again, I could see that going into dev or down in OpEx. But if it's a one-time, but every year one time, and maybe it should be accrued and amortized, something like that, a prepay, then that potentially could still go up in DevOps or in COGS.
Mhm. Okay, I'm gonna move on, but we'll save these questions until the Q&A portion.
Yeah, so Diamond, you alluded to this earlier. Yeah, so I like to say your MR schedule is gold. Treat your MR schedule like gold. So if there is one thing that you were going to focus on, if you're like, hey Ben, I'm just pulling QuickBooks P&L, and that's all the data I have in my tech business. Next, it'd be focusing on your MR schedule. This is so important to get into place. So again, what is an MR schedule? So it's revenue by customer by month. So you can see across the top, we've got our months, and then we've got our customers in column A, and that's an MR schedule. It could be called, different things, revenue by or RBC, revenue by customer by month, something like that. But this is based on invoice data. So if we're invoicing monthly and we have good invoice practices and they're hitting each period, that will create your MR schedule by customer. Now, if we invoice annually, we have to put revenue recognition in place. And usually I suggest to founders at 3 million, if you're hitting 3 million and scaling, it's time to get serious about your accounting, put RevRec in place and smooth that, amortize that, say $12,000 invoice over the 12 months, which then also creates a RevRec schedule. So of course, Simon, I've got tons of templates to help people out if they don't know how to create the schedule, or if you have RevRec in place, it should be coming out of that system. If you have subscription management software, you can pull your MRO schedule or waterfall. But this is the foundation, and this is what will be requested in due diligence. They'll want to know, send me your MRR schedule or send me your invoice data and we'll build your MRR schedule. So there's a progression here because then with this, we create our waterfall. Then from that, we can calculate retention.
Exactly. And retention is one of the biggest drivers of number one, interest and value when it comes to SaaS businesses. So it's incredibly, incredibly important. And we're going to get into that in some later slides. So just want to comment there.
Yeah.
Alrighty, so I think this section is going to be really interesting to a lot of our participants, right? So we can always talk theoretically and give best practices about M&A and P&L and what's the best practice there. But we wanted to get into a little bit of the most common mistakes that you see, Ben, when you're working with clients, because I think that's going to be really beneficial to our audience here.
Yeah, so common mistakes that I see. One is just we've glossed over invoicing, which makes a ton of sense, right? We're trying to get our product done, get product market fit, invoice the customer, just get cash in and survive. But at some point, we have to be more sophisticated with our invoicing. For example, not just sending an invoice for 100,000 that includes subscription and services. We've got to have separate revenue streams. We got to have separate SKUs or product IDs on that invoice. No start and end dates. We may be burying that subscription date in a memo field or a description field or not at all. And then as a CFO, like I can't do anything. Are the people doing due diligence? Well, like how do I spread this revenue? So invoicing, clear and distinct. Same thing with our P&L by revenue stream, SKUs, product IDs, start and end dates. So that's so important is we have good invoicing practices, we have subscription management process in place, that then we have clean invoice data. If they request that, we can create MR schedules and so on. So it all retention all starts with proper invoicing practices and discipline. So that's a big mistake, Diamond, that I see. Um, and then mistake number two, a big one, our accounting foundation. And I know we're like, I don't want to deal with accounting, but we can't just use that out of the box chart of accounts that comes from QuickBooks Zero, et cetera. And chart of accounts, again, it's just that GL numbering. So 40,000 is subscription revenue, 40,001 is usage revenue, and so on. So we have to, what I say, SaaSify our accounting foundation. So we have to have clear and distinct general ledger accounts for each revenue stream. We have to code expenses to the department level. We have to get COGS versus OpEx correct. We can't use G&A as a dumping ground for corporate expenses. And with that, then we can create that P&L that I showed earlier, that modern SaaS P&L. And that's the process, accounting foundation to SaaS P&L. And then from there, we can see gross profit, margins by revenue stream, our OpEx profile, have really good conversations with potential acquirers.
Yeah, awesome. So I think one of the issues I see, and it's actually a question from the audience too, is enterprise sales. I feel like it's a little bit easier to set up your invoicing. You're managing less customers. You can go in and be super manual about it because there's less. But how do you maintain a invoicing schedule or an MRR schedule for thousands, tens of thousands of customers?
Yeah. So when you have what I call, yeah, that high volume, low price point, usually then again, all right, where are we invoicing? A lot, of course, Stripe, everybody, a lot of people use Stripe, so maybe we're charging that card via Stripe. And then we can hook up Stripe to, say, a revenue analytics system. Or sometimes I just export all that data out of Stripe and we create those MRR schedules. So again, that would be your source is where are we processing the invoicing, the charging for, that $50 a month charge? Is it Stripe? Is it somewhere else? So we have, again, same thing, get to the source of that charge data. And then from there, either you can hook up a system to do that stuff for you, or we can use that raw data to do the same thing, create an MR schedule and so on.
Yep. And should ARR drop the moment a contract ends, or is it acceptable to carry it for a grace period, e.g., 3 months?
Oh wow. So uh, I've done so I've done hours and hours of research of how public companies, tech companies are defining ARR. And yeah, I saw this internally as a CFO is like, yeah, if we send the renewal, we don't hear from them. We posted the invoice, we're doing rev rec, like, are they going to pay? What's going on? And usually there is that lag. And usually my cutoff in that enterprise situation is like, hey, see, customer success, I don't care what you say, but at 3 months, I've got to credit this invoice. We've got to reverse the rev rec, all that stuff. And all right, if you can go win them again, perfect. So, but you see, that can affect your ARR number. So there's a little bit of volatility in those recent months. But I saw in ARR definitions in public tech companies that a lot of them disclose. They say we are including in ARR contracts that are up for renewal and that we're assuming that they renew.
Yep.
So, and that kind of followed internal practices, but some tech companies are disclosing that. And they're, hey, yeah, we're going to take credit for that until we know for sure that they're going to cancel.
Yeah, and that is a great segue into the one of the other questions that we got from the audience. How do you recommend aligning ARR tracking with RevRec, especially when contracts might renew late or include grace periods?
Yeah, so there are kind of two ways that I've seen after all this research. And one is, yeah, we could do revenue based, so if we have good rev rec policies in place and practices in place, like the easiest way, right? Go to your P&L, MR times 12. Now I know purists will be like, hey, there, credit notes and adjustments and prior period adjustments that can affect your MR number in the month, which is true, right? That's going to change month to month, but that's like the easy way. And even public tech companies, see, they're saying, hey, we're just taking MR times 12. That's our ARR. Now, the second way is contract based. Now, this requires extreme discipline on the CRM side, where companies are creating their ARR number from looking at all the contracts and what's been contracted in that current period and taking that as ARR. And they disclose, they're like, hey, this number may differ and will differ from what you see in our financial statements because it's more contract based. Even if maybe they haven't invoiced a piece of that contract yet, they're taking just, adding up all the contract numbers.
Yeah, yeah, it's actually timely. I was on a call today, a diligence call with a client. Same issue where they effectively were like, how does this translate into your actual P&L when your customers are renewing really late, or you turn the product off and then you turned it back on and you had to restart the ARR. So I think the biggest thing is buyers just want to know that you're tracking it, number one, and that it's flowing through your financials correctly when things like that happen.
Yeah.
And then the last question I'll ask here, and then we'll move on because we are
Mhm.
getting a lot of questions. It goes with all of this. So Is it risky to rely only on ARR if we're not actively managing MRR or rev rec schedules underneath?
Yeah, so right, ARR can just be MRR times 12, but if you don't have rev rec in place, you haven't focused on invoicing, we have a mix of annual invoices plus monthly invoices and we're cash basis, yeah, then it becomes a lot more difficult to figure out what's your run rate of MR each month or ARR, right? MR times 12. And that is harder. Then you've got to kind of look at, all right, my invoice history over the past 12 months. And you almost have to create almost like an offline rev rec schedule. And again, of course, I have templates for that, but you almost have to just do that homework yourself to figure out, all right, if I was on an accrual basis, what would be my MR this month? So you're kind of going through that same process you would if you went full accrual.
Mhm. Yep. Okay. So in this next section, we're going to go through like what does an actual great SaaS business look like financially? And I think a lot of this will answer some of the questions that we've already received. So hopefully they do. But when we evaluate SaaS businesses at SEG, we're always looking at how companies are going to be looked at in the eyes of buyers. So we use this scorecard to do that. And these are the most common things we see buyers really diving into in terms of both the quantitative and the qualitative metrics of a business. And as you can see here, the metrics that carry the most weights are financial. And it's because numbers are the ones that are telling the clearest story about the quality of the business. And this ties back to everything that we've all been talking about is if it's clean and if it's predictable and you can answer questions effectively, then you can prove that to buyers and buyers will give you credit for that. And no business is going to be perfect across all of these numbers, and that's okay. But again, what matters is knowing where you stand today and then being able to show the path forward. And that's exactly what I think Ben's going to walk through in the next couple of slides is, how companies can actually evolve to, let's say, zero today to a mature, financially literate business.
Yeah, so we saw a lot of metrics earlier and so important, but it can be overwhelming. So I developed this framework that helps us walk through this process because if we're 1 million ARR, what we're going to measure is much different than if we're 20 million ARR. And you see the blue arrow at the top, that's up there for a reason because if we're just starting out, if we're 1 million ARR, it's about growth. New business coming in, expansion, what's our ARPA running? Okay, we're landing customers, maybe we're expanding customers, or maybe that's coming later, but now it's retention. Are we keeping our customers? What's our logo retention, gross dollar retention, or gross revenue retention? And again, maybe we don't have multiple product lines, so NDR kind of matches GDR. But now we have to measure that retention number coming from our MR schedule, coming from our waterfall. Renewal rate's very important, of course, in annual multi-year. Then, all right, we're scaling. What are our margins? Maybe that's starting low, or usually what I see, Diamond, it starts really high. Then we invest in COGS, it comes down. Now we've got to scale that back up. So margins by revenue stream. What's our revenue mix? That also affects valuations. And then again, what's our financial profile? Measuring Rule of 40, OpEx profile, which just came up this week with the strategic acquirer. And if you have your SaaS P&L, then you say, yep, we're running this as a percent of revenue for R&D, sales, marketing, G&A. We can benchmark our business against our peers then. And then, of course, EBITDA. I like to think of EBITDA as long-term proxy for cash flow generation. And of course, all PE buyers, they love cash flow generation ability. And then finally, efficiency. And this is not only go to market, of course, we need to know CAC payback. Absolutely, cost of error, but then org efficiency. How are we running on the org side? So we progress through this framework, and this is our roadmap to slowly put these metrics in place.
Absolutely. And, do you see this as something that is in line with the life cycle stage of a business, meaning if a business is like 0 to 5, 5 to 10, 10 to 30, or can a business at, $30 million in ARR still be kind of working on their growth phase and their retention? Like, how do you look at that in terms of like life cycle for
Yeah,
businesses?
yeah, that's a good point because yeah, if you're say have $1 million ACV contract and you've got 20 customers, well, Am I going to really care about CAC payback if you acquire one customer a quarter? No. So yeah, that's why I see if you're really high enterprise, you could be a big AR number where actually you're going to still be left side of the framework. But kind of generally what I see, growth up to 1 million, just tracking our growth, 1 to 3 ARR. All right, let's think about retention. At 3 million, all right, let's start thinking about our margins. What profile is taking shape? And then profit and OpEx and efficiency, usually 5 million ARR and above. Usually I can calculate a metric in each of these boxes. And then 10 million ARR and above, then we have to start thinking about segmentation.
Yep. And this is a question from the audience is, for operational purposes, should a CFO focus on the top 3 relevant metrics? This is a long list and not everything can be a priority. So I love that question. So where
Yeah.
should CEOs be prioritizing?
Yeah, that's where CFOs, like that's where we decipher the numbers. They are, what should we focus on? And the whole point is like what's working, what's not working, also in context. So I think we'll have another slide here where you'll see kind of my color coding. But you're right, there's so many metrics here, but the point is to calculate and then to see, all right, boy, retention is really bad. All right, let's focus on that. Or maybe our margins need to go up. So we can't focus on every box, but then we do need to look at, all right, what are the top 3 metrics that really matter based on the objectives in our business?
Perfect. I would give the same advice. Okay, so we have 2 more slides here, so I think let's just power through them and then we'll get to Q&A at the end.
Yeah, so what I do is that framework, then we color code based on benchmarks. So one is like, all right, let's calculate the metrics, but also we have to see how we're performing against our peers when we do have those third-party discussions. So I'll color code the performance of our business. If you're close or hitting top quartile, that'll be color coded green. If you're kind of in between median and top quartile performance, yellow. And then if you're below median, or maybe there's this is where CFO judgment comes into play. But if you're bottom quartile in that metric, we're going to code that as red. Then we can see, all right, let's move, let's slowly progress. We'll never be perfect and have everything green. If you do have that, let me know. But we want a lot of green, a little bit of yellow, and maybe we have a little red or two, but we can explain it. We can explain why we're yellow or red and what we're doing to improve that, especially if that's a major metric.
Yeah, exactly. I was gonna add on to that what you just said. It was what I find buyers are more interested in rather than just, oh, you have red, yellow, green, is if you do have yellow and red, what's your path to either fixing that, improving it? And if you have a story around, how you're going to get from 0 to 10, that's extremely powerful to buyers. It goes back to, getting credibility and knowing that your house is in order, because buyers will see that and say, okay, it's well run. They know what they're doing. They've given me a really clear path. So when I invest or buy in the business, I can execute on that and actually help them out to get there.
Yeah, so this profile, so again, this is just out of spreadsheet. I created an app for those too, but then we can color code. We can see what's running green, yellow, red, and then we have numbers in context. And then also, right, it's a lot of metrics, but when you get that email from the acquirer and they're like, hey, I want to talk about these 7 metrics, we're prepared and not scrambling and taking weeks to come up with that, which is also a signal that you don't have your financial house in order. So now this profile, like, a lot of green, this looks really good. We know if we go into these discussions, that we've got something to stand on here that we can try to push that valuation higher.
Absolutely. Okay, so that is the end of the slides. We have about 15-ish minutes left for Q&A. We have a ton of questions then, so if you want me to flip back to any slides, just let me know. But I'll
Sure.
start from the top here. What is a good gross margin for a SaaS business? So I asked this question, I think we got a little bit into it where you said 80% for a pure play SaaS is, best in class. Any additional color that you can add?
Yep. Yeah, definitely. Because right, it's always a depends usually, and yeah, 80% is that rule of thumb. But usually, yeah, if you're running 70 to 80% overall gross profit, you're in good shape. Keeping it, and also if you're above 10 million, that'd be the expectation. If you're lower, right, you're still kind of progressing and filling out your COGS profile. But also I've helped customers where they're to B2C and they have those, expensive app store, those crazy app store fees where it's hard, they can't run at 80 because Apple is taking such a huge cut. Then we calculate margin with and without. But that's the thing, having that story to say, yeah, we're running 65%, but it's because of App Store fees. Or some companies, Diamond, have data plays. They got third-party data that they constantly have to ingest, and there's a fee to that. And that could push you below 70. But again, you've got the story behind that. You've got the data to prove that out.
Yeah, exactly. And what I've seen too is different industries are going to affect gross margin too. There are some like industries, for example, like energy, where services, managed services, it's just going to be a part of the model. It's going to be a part of the model for everything. It's or a very, very enterprisey sale where they need a lot of hand holding, for example. It just depends. So to your point, having the story around it and understanding the numbers underneath. Okay, so I like this question, and maybe it's a little specific, but I've actually seen this in a couple cases with clients. When you have a significant number of customers buying through software resellers who are the customers of record for invoicing purposes, how do you present actual customer retention?
Oh yeah, so this comes up, the whole parent-child relationship or reseller, so important. You have to break out that structure in your invoicing data because then that affects your retention schedule. So if you have, say, through a partner, through a reseller, you invoice them, they invoice the end user. Some like you've got to work with them to get that data to understand if you have a reseller or partner who just, who has 100 customers under their umbrella, but they're also your 100 customers, you do need to get that data somehow. And you also have to take credit for that, right? That's 100 customers for you, not just one partner reseller who's doing that. So that's a little bit of coordination and data required that could be part, in your contracting process with them. Hey, these are the disclosures. This is data you need to pass back to us.
Yeah, exactly. I think it goes back to, and you mentioned a little bit on this, it's like the relationship, right? Like who's actually controlling the end
Mhm.
customer and how does that turn? Like if the end customer is saying, I don't want to use this anymore, and the reseller is actually your customer, who's dictating whether
Yeah.
they're churning or not is how I kind of think about it. But to your point, it goes a lot into what's actually in the contract itself.
Yeah, that company gross versus net, all that stuff.
Yeah.
So yeah, yeah.
Yep. This is interesting. So on the P&L slide, I saw this. You had AI P&L at the top of that slide. Why do you name it that?
Well, because now helping AI companies, and again, same thing, we've got to figure out the same structure. What is it? Even AI, it could be just pure subscription revenue, or it could be usage, it could be outcome. So we going through that same process, what revenue category, even though maybe we're AI native, AI first, it could still be, all right, I'm charging 10,000 a month for something. So that's why I'm saying, now, all right, SaaS, and it's almost like now this is the tech P&L of a
Yeah.
recurring revenue tech P&L.
Yeah. And to further that, we have another question is like, how are the expectations different for an actual AI SaaS business? So for example, is negative gross margin okay to dominate distribution?
So yeah, that's the big debate. It's going to take time to play out. Is all right, and people are like, yeah, you'll never have SaaS gross margins for an AI business, but I've seen companies who do have SaaS margins for an AI business. I've talked to, when I go to events and talk to AI first founders, and they're like, hey, my VCs, they said, hey, you better have pure play SaaS gross profit. So those same expectations. So it's going to evolve. And also, talking, interviewing AI founders for my podcast, where yeah, the models become cheaper. Are they bring the models in house and they become cheaper, and there will be a way, I think, eventually to get back to those SaaS, those higher margins.
Absolutely. So this question is for me, but I'd love for you to opine, Ben. Can you expand on why NRR and logo retention is a lower weighting on slide 15? So I like this question because I get it a lot. So NRR is net revenue retention. It's great and it's valuable, but I think it could be a little bit misleading. So you can lose logos and you can show really strong NRR if you're heavily upselling into your base. Um, On the other hand, when you look at GRR, which is taking into account both lost customers and any downgrades that are happening within the base, it's really showing the true stickiness of the revenue without that extra noise of expansion. So buyers are putting more weight on GRR in almost every scenario that I've seen over NRR. And then the logo side, logo retention is really important as well, but going back to segmentation, if your logo retention maybe doesn't look great, but you're looking at all the customers that you're actually losing, and the ARR for all of those customers are very small or it's far below your average, does that really matter? Maybe, maybe not. When you're actually looking at the pure ARR that you're keeping around and those customers are happy, and maybe that's your true ICP, that's what buyers care about. They want to know that it's stickiness with the customers that you should actually be selling to.
Yeah, yeah, totally agree. I mean, and just like ARPA underrated metric, what are you gaining new customers at? And that gets to the ARPA. Are we losing low ARPA ACV customers where logo retention would be effective, but GR looks good? So that's where, getting into the nuances of your MR schedule.
Yep. Yes, definitely. Okay. So let's see. There's a lot of questions, so I'm trying to decipher which is the most beneficial for the group. So is there a standard definition for what costs are captured in?
Oh, and CAC. Of course, I like to say, no standards in SaaS metrics, even though I'm on the SaaS metric standards board with Ray Reich and others. But yeah, CAC. So of course, we start with sales and marketing expenses fully burdened. So wages, taxes, benefits, travel, commissions, President's Club, all that stuff, Wi-Fi fees, pizza parties. So sales and marketing fully burdened, and then for CAC, right, we have to make that allocation between new and existing, what's dedicated towards new acquisition versus existing, and then from there, CAC payback, cost of ARR. But it goes back to our SaaS P&L, having everything coded to department level and fully burdened expenses, that we're not cheating and putting expenses in different buckets. Like we've got all benefits down in G&A. So, that goes into CAC and then flows through the calculations.
Okay, so this is a good question. When evaluating a SaaS business for acquisition, how do PE shops weigh SaaS metrics compared to how a strategic buyer might value them? Are there particular metrics that each group prioritizes differently when forming valuations? So I'm actually going to flip back to the scorecard slide. So I would say the biggest difference that you're going to see between PEs and strategic buyers is strategic buyers are always going to be looking at synergies between the two businesses, both in terms of the technology and the product, whether they can cross-sell that into their base. Are you filling a gap or a hole in their product set that's going to make this very accretive to them? Of course, you get into the nuances if it's a public company, if it's a private equity backed strategic, and they're trying to fulfill some certain metrics and make sure that your growth or your EBITDA is accretive to their financial side. I would say for the most part, strategic buyers are going to be looking at the product and technology, whereas PEs, they're going to be very, very heavily focused on the numbers that you see on the slide, the ones that say high. So they want to make sure that your GRR is high, you're growing, you have some EBITDA, some margin, basically looking at your rule of 40, are you growing efficiently? And this is all for them to be able to model their future growth and their future returns. And like I said, the metrics and the numbers are telling them the clear story of like the baseline of where the business is and where it can go. So to reiterate, the biggest difference is going to be, strategic, looking at tech, product fit, and then PEs are actually going to be looking more deeply into the metrics, I would say.
Yeah, agree with that.
Okay. Okay. So, from your perspective, what are the 5 most important SaaS KPIs, and what ranges or benchmarks should companies aim for on each? Do you want to take that
Ooh,
one first?
so that's always clickbait for me when I see the top 5 metrics, the top 10 SaaS metrics. I always have to look, even though if it's not a great post. But I think this comes from helping a lot of SaaS founders. Is like we present these metrics like Ben, like hey, what what should I focus on here? Like what's so important? And one gross, and I actually have what I kind of coined the power 3 metrics. So one is gross revenue retention. Like you said, Diamond, yeah, NRR is good, but it's the base of gross revenue retention that builds good NRR. So gross revenue retention, then gross profit, right? We have to deliver revenue efficiently. That unlocks cash flow. That unlocks, then we can invest in R&D, sales and marketing, and so on, and hopefully trickle down to EBITDA. So gross revenue retention, gross profit, and then the metric I created, the ROSE metric, is the amount of recurring revenue you're generating for every dollar of employee and contractor investment. So important. Usually, what I see, this is a great test. Do it in your business today. Is can you beat $1.50? Usually, when I see companies above $1.50, they are consistently generating EBITDA. They're very consistent financially. So we have health of our recurring revenue, we have efficient delivery of revenue, and then we have underlying org efficiency as far as like three, for me, three key metrics. And then like CAC payback also, that's a top operator investor metric. You could add that to the list. But again, right metrics for the right stage of your business.
Yeah, I would agree with that 100%. Okay, so do you recommend that all private companies comply with FASB RevRec rules?
Yeah, so RevRec, like I said, if you're 3 million ARR and scaling, it's time to get serious about accounting. Then, especially if you have annual invoices, I would put RevRec in place. If you don't have bookkeeping, go find a good outsourced bookkeeper who knows SaaS. I know a ton of them, and they can put accrual books in place because it's just going to make your life easier. You have to go from cash thinking to now the economics of the business. So yeah, around 3 million in scaling, time to get serious.
Okay, this one's an overarching one, so I like this. What are the trends that you're observing in the last few quarters for B2B SaaS companies? Is growth slowing across the board, or does it vary largely by vertical? And then how about valuations?
Yeah, I think, yeah, I mean, definitely valuations depend on the vertical, and you can see that in like public comp data. But we know just from the reports, like it's B2B, it's been hard. Growth has been harder, especially if we're selling in enterprise, mid-market and above, that it's been a little bit slower. So then that's where it's like we've got to be disciplined. We've got to know our numbers. We have to be forecasting what's our cash runway, that we're prepared for anything that comes in the future. So yeah, I'd say just and again, it depends on the vertical. Like there are some companies it's always like growing crazy, and then others where it's a little bit slower. And of course it depends. Are you bootstrapped? Are you VC funded? Which vertical? Are you AI first? But SaaS. So a lot of factors there.
Yeah, I would agree. There's a lot of factors there. I would say in the last few years, to your point, Ben, we have seen businesses start focusing more on bottom line just because it was a little bit of a shaky market. And we saw that in the M&A markets too, that they started to favor businesses that were growing more sustainably. We're seeing a little bit of a pushback towards growth because things are stabilizing a bit. But I did see that with a lot of companies where they said, all right, we got to hunker down and just make sure that we can sustain this going forward. And then in terms of valuations, it does depend on the product offering, the category, the vertical. But as I mentioned earlier in the deck, valuations have been holding pretty steady, which is great, but we have seen that division between the top performers and everyone else in terms of who is actually getting rewarded. And we are seeing, those AI companies kind of jump up in terms of where the value is actually going. Okay. So there's a lot of questions on gross margin. So I'm going to get through a lot of them, but when calculating professional services gross margin, would you include managed service revenue? Because that keeps coming up. So I think we should address that.
Oh, yeah, and that's a tough one. I think if both are initiatives, like you have PS plus manage, I think it's good to calculate both, but sometimes the people are coming from that same cost center. Like they could be doing implementations, managed services, then you have to do some sort of allocation. So I would definitely have revenue separated. Maybe you have one services bucket on your COGS, part of your P&L, but then offline, I would do kind of like a product P&L allocation, and I would do something pro forma to figure out the margins between the two.
Yep. Okay, we're towards the end here. We have a lot of outstanding questions, unfortunately, but as we wrap up, Ben, I want to just thank you so much for this very insightful conversation. It was fun, and your perspective is just completely invaluable. So thank you. And to everyone who joined, thank you for joining. I hope that you have a clearer view on how a strong P&L can really fuel your growth and create alignment and build confidence with buyers. And there's a lot of questions that are outstanding. So if we didn't get to your question, or you'd like to just continue the conversation with either myself or Ben, please reach out. A short survey will pop up as you exit, and then we'll also send everybody a recording of today's session into your inbox. So thank you everybody for joining. Thanks again, Ben, and enjoy the rest of your week.
Yeah, thanks everyone for joining. Enjoyed it.